What happens when you blow a bubble too big? It pops. You came here for the truth, so let me unveil that for you. In today's video, we are going to talk about the statistics, the actual metrics, which will show you, is the stock market in a bubble, yes or no? There's a lot to this, there's nuance, and I want to break it down, make it really easy to understand. Let's begin. The very first thing we need to look at is NVIDIA. At the time of this recording, they reported their earnings. They were even better than the bullish analysts were thinking it was going to be. And so, of course, in after hours trading, this thing goes up 9%. Already, this stock has gone crazy. And here we go, another 9%. Now, over the past few days, there was a little bit of concern. Uh-oh, are they going to be able to beat their earnings? They're already going crazy. And yes, they did. Now, look, when your CEO wears a leather jacket up on stage, you know that things are going to be, fantastic. And when you say the word AI, every fourth word, you're going to do well. Okay? This is not driven by fundamentals. Yes, the forward PEs. Yeah, I get that. When we talk about earnings, right, we have to understand what's going on right now. And this is something that has always been. We have to look at when they report their earnings. The expectation is one thing. Do they beat that expectation? Well, maybe they do. But where did they set that bar? So that is a factor. For NVIDIA, the bar wasn't necessarily set low. They exceeded that. The demand for AI related stuff is very high. But let's be honest about what we call AI. They're using that term everywhere. Everywhere. Even the stuff like a chat GPT, which is AI in a sense, is not really the AI that we were told like 5 years ago. This is artificial intelligence. This is sentient. This thing is going to come alive in the night and choke you out. This is a different scenario, right? Now we're just like, hey, let's put AI on the top of it and you'll get more. That's the kind of thing that we are seeing. So I need to make that distinction. So companies that are buying from NVIDIA, whatever that could be, okay? All these companies all around the world, they are purchasing their products. They are getting into it a lot of times just because they want to attach AI to what they're doing. The whole game is rigged. But understand this right now that they are seeing a lot of attention. There are other companies, though, like SMCI, that were rising up at the same time, but have been smashed down. Now, who knows? At the time of this video, things might be different than when you're actually watching this the next day. So keep an eye on that. Just understand what AI is being thrown around there. There's nuance. Let's get into the other aspects. When we talk about the fear and greed index, that's one element. And they're just slightly, they're at 77 into this extreme greed scenario. It's just one indicator of many. We've got the VIX index, which is still relatively low. It's at 15. And this measures volatility in the stock market. There hasn't been much volatility at all. The market has been pricing in a lot of cuts this year. How much? 1%. They expect by the end of the year, there will be at least 1% from where we are at today. And that's what this market is riding on. They are right, like where the market is today, where all these stocks are today, are because of what's going on with the Fed interest rates. Now, what are we seeing here? Is this a bubble? Like, how do we measure that? Well, I want to take it and compare it to something else, because just seeing NVIDIA stock going up 10%, 20%, 30%, hundreds of percent doesn't necessarily mean it's a bubble. We've got to compare it to other things. Yes, we can look at the forward PE ratios that everyone likes to note, but there are so many other things. So let's get into that. I could show you a few things. Total returns in USD since March 2015 indexed to 100. The Magnificent Seven Index. Okay, so you know that the S&P 500, the NASDAQ, the stocks 600 to a lesser degree, These indexes have performed very well recently, right? Absolutely. And over time, hey, it's 7%, it's 10%, whatever number you're being quoted. But look at this magnificent 7. Just in this past, year and a half to 2 years, we'll say, it has gone crazy. Absolutely crazy in the last year and a half. Straight up. So since 2020, if you even factor in that dip and you just held on, things went wild, didn't they? And what has happened over this period of time is that we have seen this insatiable appetite for risk. There has been no slowdown in risk. All right. It was a very brief moment in time where, things were really concerned. They're going to need to bring interest rates up to 20%, up to 50%. Oh my goodness, inflation won't stop. As soon as they decided that, inflation's probably going to slow down here. That's their metrics, by the way. Everything turned around. And that's where we see it today. The top 10% of stocks by size versus the entire US stock market. So to my friends on Finance Friday, look at this, okay? You could see what has happened. It's unbelievable. I mean, this chart goes back to 1926, just to give you an idea, okay? And certainly, we have gone way above the median. It's not healthy. You got to understand this. It's not healthy in any way you look at it to have stocks that just like when you look at the broad index, hey, the broad index is doing well, stocks are doing well. But then you break it down and you say, oh, it's really just a handful of stocks. So something is off. Do all of the other stocks need to catch up to these select few? Or are those select few just too high? And you can't say, look, let's say the S&P 500, you've got 500 stocks. There are always going to be very poor performers in there. Very poor, even though that might be one of the biggest 500 companies. Look, let's be clear. There's always going to be those ones that do terribly. But when we're talking about the top 50, the top 100, if you're not even anywhere close, there's a problem. There's an issue. We have more and more and more and more concentration. People are looking for that yield. They're looking for a return. And if they're not going to get it, they are going to go into NVIDIA. They're going to go into these magnificent 7 stocks to try to get some yield. They're saying, you know what? I'm going to leave that one behind. I'm going to leave that one behind. And I'm going to concentrate here. And the more concentration we have, the more risk. Think of the analogy. You're on a pond, frozen over. All right, the pond is completely frozen over. You go on, first of all, you look at it, you knock on it, completely hard. So you walk on it, everything's totally fine. You're dancing on there, you're doing cartwheels. Everything's all good. Then your friend comes on. Then he invites another person, and they invite another person, and suddenly their family comes. They start bringing cattle along with them. Hey, a few raccoons join in, why not? And as the more people are added in, you suddenly have an issue with that frozen over pond that wasn't a problem before. The crowding causes the issue. That's what's going on right now. Tell those raccoons to take a hike. All right? For me, that's a personal one from me. Market cap of listed equities in G20 countries by domicile, plus the Magnificent 7 and the 7 largest stocks in Europe for comparison. This is crazy, okay? Just looking at compare this as a whole, you could see all the different countries' stock markets, and then compared with the second one, which is the top 7 stocks in the United States. It's bigger. Those 7 stocks are bigger than all the other country stocks put together, basically. Look at how massive these stocks are. Each one of them, they have bigger, their values are bigger than the GDP of many countries. Like it's beyond imaginable. Does that mean it's a bubble? No. But when I see breadth being how widespread is how widespread is basically the growth of these stocks. It's not very good right now. That's what we're being told. The Magnificent Seven profits now exceed almost every country in the world. Almost every country. Isn't it crazy to see this? There was a lot of this happening in the year 2000. We know that. But, I don't want to be the one to say it. This time is different. But that does not mean it doesn't, eventually end up in a problem. Let's be honest about that. Yeah, it's different. There's a different scenario right now. There were companies back then, which reminded me a lot of the SPAC, like 2020 timeframe reminded me a lot of the dot-com bubble. That I saw the difference, like the comparison there, because you had JPEGs, the NFT thing, and like, why was this becoming worth millions of dollars? Like, there was no explanation behind it. Oh, this is the future. You are gonna want to own digital property next to Snoop Dogg. I was reading that. I can't even believe I just said that. Anyway, that's what happened. And that to me was more like the dot-com bubble. Because there were, I have been in the offices where we had former tech companies. I think there was one guy, if I remember correctly, there was still one guy. But the rest of that business was completely gone. This is many, many years ago. This is like after dot-com bubble. Everyone's laid off. I think there was one guy in that building, if I remember correctly. And that's what happens. You get the remnants left over if there's anything. I mean, goodness. But today there's structurally different things, okay? Because there is value behind these companies. Apple is a very valuable company. Does it need to be, by the end of the year, it'll be worth like $7 trillion. Does it need to be there? That's up to you to decide, all right? Where should it be? The level of concentration has led some analysts to voice their concerns over the related risks in the US. And of course, we're seeing that not just in the United States. There is some, excessiveness taking place in Europe, but it's not even close. It's not even close when you think about it. So those are the stocks right there. Stocks like Microsoft, I've talked about before to the Finance Friday group. Things are really going wild. Retirements spike again as the stock market booms. And so people are saying, hey, I've made so much money, I could retire. People are in a rush to retire sometimes. If the stock market goes down, though, are they going to try to get back in the workforce? I mean, it's crazy to see how these things happen. I really don't think people should just your portfolio is suddenly worth a little bit more and you go to retire. Odd. You tell me what you think. Would you just retire if your portfolio is suddenly worth 20%? And your retirement account, is it full of NVIDIA? Be careful now. This is the leading economic indicators. Imagine just a bunch of indicators squished together and what's happening. And these have come down. All right. And I want to show you something. So that red area there on the right-hand side, that is the month over month. And it's been bad month over month over month. However, when we look at it on a year-over-year basis, it has bottomed out. And historically, when we see this, it tends to rise. So the expectation here, what you're seeing here, is that the worst is over. We're likely kind of in a recession, technical recession. They're not going to admit it. We know that. But bottom is sort of in, and not for the stock market, but for the economy. And then it goes up. Now, why is this important? How is this related to the stock market? Is that if there isn't a recession or it's a mild recession, then companies will likely be more inclined to hire. If they're more inclined to hire, there's more money to be spent in the economy that could find its way into the earnings of companies like NVIDIA and all these things. And so we can push that higher. Where it ends up, nobody knows. Is this a bubble in many metrics? Yes, it is. Does that bubble necessarily need to pop now? No, it doesn't. Things can stretch on for a long time. What we need to see is this. You have to find out, as time goes on, this will occur. If the other stocks start coming up to this crazy level, or is it more and more and more and more concentration? It's not the Mag 7 anymore. It's the Mag 6. It's the 5. It's the 4. And we have something happens. Something pops. So that is really the indication that we need to find. What's going on with breadth? Breadth is very important to see the stability in this market in the coming days, weeks, and months. If you are interested in this stuff, in depth, I cover that every Friday for 2 hours. 2 hours every single Friday. themoneygps.com/live. There will be a link in the description as always. That's where I can cover this stuff live, taking questions, going on and breaking this down so you understand it at a deep level. The real financial education that, quite frankly, most YouTubers won't do because it doesn't get the clicks. Well, I appreciate you being here. Hit that thumbs up button on the way out. Can we get the fireworks to happen? All right. I want to thank you for being here. And as always, I'll see you tomorrow. Take care.